this morning, you are seeing the first jitters of the debt ceiling on US equity markets. So the handover from US equities is a weak one, Nikunj, and the SGX Nifty is indicating a downtick of about almost 0.5%.
Normally with a 70-point downtick on a Nifty or a little bit of weak handover, markets would have ignored it. But in general, I guess this week's price action is not that exciting, if I may say so. In a week when Adani Group of stocks have made a rara comeback, Nifty frankly has struggled, and FI buying also has been strong. So contours which should drive the markets higher. Big flip in Adani Group of stocks, FI buying continues, no fresh short selling in the market, and Nifty has yet struggled to cross 18,400. At higher level, we are getting pushed down. At lower level, this market is finding little support. So I think from a market standpoint, you could see two parallel markets now. Nifty is certainly entering into a zone of consolidation, and mid and small cap stocks, they continue to rotate, and I think the rotation is clearly visible because now the rotation rally has started moving down the ladder, so to speak. So it's not that we are staring at a big reversal from a market standpoint, but I think timeout is the word which I think is evident looking at the construct of the market and the fact that we are not really reacting, acting, or there is any kind of excitement based on what is happening in terms of liquidity, Adani Group of stocks, and the underlying bent of earnings season.
Yeah, and speaking of the Adani Group of stocks, they were all the rage yesterday across the board. You had a lot of those stocks which recovered very smartly. In fact, something like an Adani Ports recouped the kind of losses that it had undertaken since the Hindenburg report came out. And that's some interesting data as well on your screen, how the stocks have recovered quite comfortably, and the three-session delivery data as well for the Adani Group companies. So the 10 listed firms in the conglomerate all did did see a lot of reprieve in trade, and that's largely on the back of the clean chit that they got from the Supreme Court panel. Not just that as well, sources indicating that Rajiv Jain's GQG has been buying into the Adani Group stocks over the last few days, and Nikunj, stocks worth about $2 billion now.
There's a big buyer in the market, and I think that big buyer is something who is ready to commit to more capital to Adani Group of stocks. I'm going to take the clock back before we talk about what's the way forward. If you take the clock back, look, the stock sold off because of the Hindenburg report, which raised concerns which were centered around high promoter leverage, interparty transaction, huge debt, and the company will struggle to pay back to their lenders. All those concerns have got addressed. So really from a market standpoint, the concerns which in a sense had enveloped Adani Group of stocks, that's behind us. Then there is part two. Is there, after the sell-off, are institutional investors coming back? The biggest challenge for Adani Group of stocks historically had been that their shareholding pattern was not very widespread, and there were no large marquee names in terms of who'd invested in their stock. But I think GQG had silenced all the Adani critics. Now the fact that even though the stocks have seen a run-up of about 50 to 100% from the recent low, GQG is still interested, is still buying from the open market. They've increased their stake by 10%. B, they've already indicated that we would be participating in the future fundraising exercise for Adani Group of stocks. Now what had happened post the Hindenburg report is that Adani Group had to hunker down a lot of the future growth expansion, because in infrastructure business you need capital to grow, and when capital is not there, you will have to hunker down your growth plans. So now markets should breathe a sigh of relief that a lot of the plans which were on the back seat, could they be coming back? Could the second half mark as a revival for Adani Group of stocks? These are long gestation projects, port, railways, energy transition, green hydrogen, all of them. You cannot take a very short-term view, you have to take a long-term view, and that's what I think an investor should do. In the short term, what happens, look, excitement and liquidity is back, and delivery-based buying is also there. So now it's a judgment which is purely based on technicals rather than deep value. I think the deep value in some of these stocks is over. They're up 50 to 100%. But for somebody who wants to take a 3 to 5 year time view and say that, look, India is going to be strikingly different, Adani is going to play a large role in terms of how the airports would be functioning, or the ownership in ports or in green hydrogen, then they should be part of everyone's portfolio. But you got to prepare yourself for volatility. These are not very cheap stocks.
Well, that deep value was surely identified a while back. Remember, yesterday we told you GQG Partners, Rajiv Jain, has invested more in the Adani Group of stocks. We spoke with him back in March when, we were in the thick of all that was happening with the Adani Group and the stocks were tanking. We spoke with him exclusively, asking him about what makes him so bullish about the group. And here's what he told us back then.
The fact that Adani Group of stocks by traditional yardstick are expensive and that debt levels are high, as a fund manager, as an investor, what gives you the conviction that both the concerns which historically have been big concerns for Adani Group of stocks, those concerns, according to you in your playbook, is something which is manageable?
See, if you look at vast majority of the assets are regulated assets. They tend to a very, very long tail. So when you can't have financial leverage along with operating leverage. These companies have very sort of predictable long-term trajectory, even if you slow down the growth. So that's the first part of it. And when you adjust for the leverage, in fact, if you look at the US utilities, and we own a bunch of them, on an average debt to EBITDA levels in US utilities, and these are some of the best of the breed, is around 6 to 7 times debt to EBITDA. If you look at the leverage here, it's around 3.5 times. But the growth capex is why the negative free cash flow kicks in. So I think they have predictable earnings stream that has 20+ year visibility. These are regulated assets, and in growth utilities they tend to have negative free cash flow. That's the norm. That's, in fact, you want to have them. You want to have them have negative free cash flow. That means because they're able to deploy capital on a longer term basis with fairly attractive returns. So the debt levels, when you look from a utility perspective, is actually on the lower side, not on the higher side. But if they lower the capex plans, which they already announced, I think it becomes a fairly attractive sort of risk reward.
All right, that's the word coming in from Rajiv Jain the last time we spoke with him. But that aside, let's also focus in on what's happening when it comes to the global markets. You did have the three major averages falling in trade, Asia as well reeling under pressure, and that's largely on the back of the latest talks with respect to the debt ceiling. It has been yet another day of no results because the House Speaker has walked out of the US Capitol building, saying that the two parties are yet to reach a deal in order to avert that first ever US default. There are more meetings that have been planned here on, and the Republican representative as well, which is one of McCarthy's chief negotiators, has suggested just hours after the meeting that the two sides have actually seen a standoff. So clearly you can see that playing out on the global markets this morning. And Nikunj, the fact that there's been a standoff and questions being raised of a potential default, that could be a little bit worrying.
No, if US defaults, then it'll not be a little bit of worrying. It'll be a lot of worry, trust me. Then there would be almost like an, financial, financial Armageddon. So US has never defaulted. And I was looking at data, and I think we were discussing that it's only once in the history that the US Federal had shut down because they were not getting the budgets. The difference in US government shutting down because they were not getting budget versus debt ceiling default. Debt ceiling default means that the US paper does not hold any validity. So that's not going to happen. It's just that who can squeeze in a bit more and who can squeeze in a bit less. Who really wants to have that last say, so to speak, that, I'm the one who is the boss. So it will sail through. But the point is that really from a market standpoint, markets would wait for that last minute negotiation, because that last minute compromise is something which markets would look forward to. That what would be that icebreaker in terms of getting the debt ceiling in terms to sail the debt ceiling. That is something which markets would be looking at, because trust me, if the debt ceiling does not go through, we are looking at not bad, we are looking at an ugly situation in financial markets.
Yeah, absolutely. Well, they will not let it fail. That seems to be the messaging, at least as of now.